Welcome back to the show. This is episode 10 of the Capital Compounder Show. Today we have a very special guest. His name is Derek Foster, and Derek is Canada's youngest retiree. He was in all the newspapers, all the media, on TV. Years ago, I remember following him. He's also in my book, Market Masters. For his ability to basically retire at the age of 34 is amazing, increasingly more challenging today. And he was able to do it while growing a family. Derek, you're up to, I think, 8 kids now. Is that right?
I don't say up to because we're done, but eight kids is what it is. In fact, my oldest son just got married a couple of years ago, and he had a kid as well. So I guess I have a grandkid as well. So there we go.
That's just great. So you don't come from like a wealthy family, Derek. Like, let's set this up, right? Like, tell me about your early beginnings. This wasn't a trust fund
Yeah, no,
that you came on to at the age of 34.
no, that's a fair point. First of all, going back, you introduced me as Canada's youngest retiree. I realized that I retired 20 years ago because people are going to look at my picture and go, that guy's not that young, you know what I mean? So that was 20 years ago, so there we go. But that was when I was 34. I'm 54 now. Yeah, when I was young, my just basic middle class lifestyle. I mean, my dad had a used appliance store. I mean, he did okay. But when I was a young kid, I got hooked on the game Monopoly, and I liked the idea of, acquiring properties and making money, and this was so much more appealing than passing go. And so as I got older, I thought, having assets that generate money as opposed to working for money just made sense. So that sort of got me on my way, if that makes sense.
Yeah, totally. And then when you did retire early, you wrote some books on it yourself.
Yes.
The first was called Stop Working, and then you also wrote the book The Idiot Millionaire. And it's a really simple approach to retiring early. Can you walk me through the approach? How did you do it?
Yeah, so first of all, you got to realize that my IQ is pretty low. I'm not that smart a guy, so I had to deal with the cards I've been dealt, sort of thing, right? So I focused on very, very simple things. So I say, as an example, like I focused on potato chips rather than computer chips, So for example, for many years, I owned shares in Pepsi, which owns Frito-Lay, which owns Doritos, which owns Lay's, whatever, right? And so very, very simple, very, very basic. And the other kicker for me was focusing on dividends, you see, because a lot of people, when they're investing in stocks, they were looking for something to buy for $1 and sell for 100 or whatever. And that's great if you can do it. But I focused on dividends. And dividends was that recurring income stream that came quarter after quarter. And I also looked for companies that had a regular habit of increasing the dividend stream. So an example in one of my books was Colgate toothpaste. I mean, this is not rocket science. I mean, we hope you brushed your teeth today. I did, And odds are you used one of 2 brands, Colgate and Crest. And, when my dad was young, he would have used one of 2 brands, Colgate or Crest, and same with my grandfather. And it's been around since something like 1890 or whatever. And it's been paying dividends all that time. So you've gotten paid every single year. And it's increased dividends for over 60 years. So, during the First World War, during the Second World War, during the Great Depression, I mean, even since the Toronto Maple Leafs won their last Stanley Cup, Colgate was paying dividends. And so I'm not advocating for Colgate. The stock is probably a little expensive right now, but just as an example, so these companies that just regularly increase dividends year after year after year, very, very simple. You sit on your assets, you do nothing, and you collect the dividends. And that was the main gist of my book, The Idiot Millionaire. It listed 50 or so companies that I thought was simple enough for a 6-year-old to illustrate with a crayon that regularly paid dividends.
So businesses that we all know,
Yes.
right? Products that we all use.
Yes.
They pay a dividend, and they pay it consistently.
Yes.
Year after year after year. So you're generating dividend income while you're investing in these companies. But up until the age of 34, you're generating income and you're plowing that income into dividend stocks. Is that right? So walk me through those early years.
Yeah, so there was a variety of things. I actually didn't have much of a career job because, like, I, did the typical university route, got a Bachelor of Commerce degree, graduated in 1993. Had a series of part-time jobs. Radio Shack at the time, I mean, nobody even knows Radio Shack anymore. It was now converted to The Source. It sold like electronics and stuff. I don't even know about electronics.
I remember going with my dad, right? That was way back though.
Exactly. You're making me feel old. Thanks, Robin. But anyhow, yeah, so worked there part-time or whatever, but I was kind of focused on having fun a little bit. So I think in 1994, I went to Europe, backpacked around for a summer. That was great. So I got a working holiday visa in Australia, went to Australia, spent a year in Australia, well, not quite a year, 10 months or something, and then a month in New Zealand and came home. And then I moved out to Vancouver, and I was a telemarketer for a while. How annoying is that? But anyways, yeah, I did that for a while. And then I went to Korea. I taught English for a few years, met my wife, Yeah, and then we came back to Canada. I guess we had 2 kids, and then I retired. Now, during that time, I was religiously saving a minimum of $200 a month, and you got to remember this is 20 some odd years ago, so $200 was a little bit more, but a minimum of $200 a month plus any windfall money. So, for example, when the GST was implemented, they started sending in quarterly GST checks. I would save that. If I got my tax return, I would save that. If I got some bonus that ran into some money, I would save that. But there was no lottery winnings. There was no inheritances. I didn't come from a rich family. It's just basic, steady, basic stuff kind of thing.
So plowing money consistently into dividend-paying stocks and building your portfolio. There was a little bit of rocket fuel, right? I think you did fast forward a little bit in your retirement journey, so you could retire at 34. And I believe it was Philip Morris. Can you tell us the Philip Morris story?
Yeah. So at the time, and this is going back again, but the tobacco companies in the U.S. were being sued because they had hurt people, basically. They had harmed them, and the states, in the United States predominantly, the states were trying to recover money for medical expenses. So they were debating this back and forth. This is going back to the 1990s. But essentially, the stocks just cratered because, they were going to go bankrupt. But my perception at the time was governments like money. Okay, at the end of the day, they're not altruistic. They want the money. The tobacco industry is a cash cow. They're not going to bankrupt them. Something's going to be, happen, right? So I bought shares in the company at the time. I forget what the dividend was now, but it was over 8%. Like, it was phenomenal because the stock price had been beaten down so much. And I even went on margin, which I advocate. Nobody, please don't do this. I was stupid and young and whatever, but I went on margin. I really ratcheted up my holdings in Philip Morris. It turned out fairly well. There was a settlement, I don't know, 6 months later or whatever, and they agreed. I forget exactly the nature of the settlement, but they were going to have to pay back, I don't remember now, let's call it $100 billion, but it was going to be over 25 years and blah, blah, blah. And I did deep dive into the companies, but for example, Philip Morris, for every 5 cents that they increased a pack of cigarettes by, they generated something like $1 billion. Like, it was absolutely phenomenal. And the other thing I will add is I focused on Philip Morris because in the consumer product space, generally the market leader stays the market leader. I'm not talking technology. Technology changes really quickly, but in the consumer product space. So, for example, Coca-Cola was the top brand in 1900, and Coca-Cola is the top brand here today in 2023 or whatever. It hasn't really changed, okay? But the tobacco industry did change because R.J. Reynolds was the market leader for many, many years with Winston and Camel and whatever. And Philip Morris came out with their Marlboro Man commercials in the 1960s and 70s, and they actually gradually surpassed them in market share. So their liability was much less because it gets complicated, but their smokers were younger at the time. The warning came out in 1965, Surgeon General, smoking's bad for you, which offered them some sort of legal protection. Anyways, long story short, bought Philip Morris. It went up, I don't know, a third or half within 6 months, and I sold it, and it got me boosted, I guess, yes. And I don't advocate a margin, though.
Yeah. It was a big, bold bet that paid off, and while it was paying off, there's that dividend, right? The 8%.
Yeah, absolutely. I would add, when I went on margin too, I forget what the interest rates were, but they might have been 6%, and that was fully tax deductible because if you borrow money to earn an income, it's fully tax deductible. But mind you, the dividend is taxable as well. But the dividend was like 8.5%. So I was actually getting paid to borrow more money, if you follow what I mean. But there is a risk.
Absolutely.
Yeah.
There's an arbitrage opportunity. There's a 2% delta, right?
Exactly.
That basically you're able to pocket. In addition to the tax deduction, right? Which is a good tip. It's something that wealthy people take advantage of that not a lot of people know, right? You can actually deduct that margin and trust.
It would work better if it was Canadian stock because Canadian source dividend income is better. I won't get bored, but it is, yeah.
And so when you started your wealth building journey, what was the number you had in your head? What was the dollar figure where you said, you know what, as soon as I reach that dollar figure, I can retire, I can make this work?
Yeah, I don't mean to undercut you here, but I think that's the wrong question because I think a lot of people focus on having a certain number, but nobody really operates that in their day-to-day life. What they operate on is how much income do I need to live, right? Very few people get a job, say, okay, you don't have to pay me anything for 10 years, but in 10 years, give me $1 million. Like, nobody operates that way. They say, I'm going to date myself here. I need 50,000 a year. You need a lot more now, but I need 100,000 a year. I need whatever, right? And it's that much per year. So I focused on how much dividend income do I need per year to retire? And the nest egg amount, I'm not going to say it was irrelevant because, of course, we all look at that, but it was less relevant. Does that make any sense?
Absolutely does. So what was that monthly dividend income figure that you're looking for to
I mean, again,
basically sustain yourself 34
we're going
ages and older?
we're going quite a bit back, and I
Yeah.
just want to explain it in totality here as well. In Canada, we live in a high tax jurisdiction. I mean, we can debate politically whether that's good or not, but it's a fact. Okay, it's a fact we can't escape. Now, if you have two people, let's say if twin brothers, one makes $100,000 a year in employment income, the other makes $50,000 a year in dividend income. Who has more money? Well, let's figure it out. Well, the guy making 100 grand a year is going to pay CPP, EI. The guy that has 50,000 in dividend income will pay nothing and nothing. This guy who's working is going to pay union dues, professional dues, commuting costs, maybe childcare expenses, whatever. This guy's going to pay nothing, 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 nothing. And then this guy's going to be taxed at his top marginal rate, whereas this guy's going to have dividend, especially if it's Canadian source dividend income, going to be favorably taxed, or it wasn't available for me, but now you can shelter money inside a TFSA or whatever. So this guy is actually going to have a lot more at the end of the year to buy, Timbits and jelly beans or whatever than the guy making 100. Okay, so my figure was a lot less taking that into account. So going back 20 some odd years, it was about $3,000 a month. Is what I was looking at.
So this is really important, right? A lot of viewers might not know this, but we're obviously in Canada, and there's a huge tax advantage if you're just generating income from dividends.
100%.
So it's $50,000 you're making per year just in dividend income, and you're not taxed. Like it's 0%. Is that right?
Yeah, I don't have the up-to-date figures, and of course it changes marginally, but effectively, yeah, I think I wrote that in one of my books. But again, I don't know the dollar figure precisely, but it's around $50,000 a year you can earn in Canadian source dividend income without paying single penny in tax. So hypothetically, if you have my wife and myself both making $50,000 a year, we could pull in 100 grand a year and not pay a penny in tax. We don't pay CPP, we don't pay EI, there's no commuting costs, there's nothing, okay? So when I looked at the figures back in my 30s, I said, I cannot afford to work. It's too expensive to work. So why do I want to do this? Why do I want to beat myself over the head? I'm going to retire. And that's essentially what I did.
This almost sounds like Canada's best kept secret. People don't learn about this in school. It's not in the news, right? Like some tax accountants might not even tell you, right? When you go to hand in your tax documents every year.
Absolutely.
It's a strategy that people don't talk about.
Well, most people are focused on their next promotion too, and so they get a promotion, they get $10,000 a year more, but 5 of it's gone right out the door. So you're running on a treadmill to try to keep up. It's really, really hard, and there are costs related to working as well. So yeah, absolutely, like 100%. And it's even better now than when I retired because you do have the TFSA. And I'm a boring guy, but January 1st, obviously it's not the first because the banks aren't open, but second or third or whatever the first day the bank is open, I'm going in and I'm transferring the maximum amount to my TFSA, and that's all tax-free income. It's totally irrelevant to everything. So you have this extra bonus that wasn't available before there as well. So it's amazing. It's incredible, really.
It's the cherry on top, right? So you can just maximize your tax-free income, basically.
Yes, yes. And I would add, too, it doesn't affect me, but for younger people, the first-time homebuyer savings account is also another gift. It's even better than a TFSA, but that's for your younger viewers. But anyways, yeah.
So you retire at the age of 34. You're generating, let's say at the beginning, around $3,000 a month.
Yes.
The financial crisis happens.
Yes.
And your portfolio goes down, what, 30%? Broadly?
50%, something, I don't know.
50%?
Yeah, maybe.
Okay. So, Derek, that's pretty scary, right? Like you're retired.
Absolutely.
You're relying on that portfolio. What do you do when you have that major drawdown in the crisis?
I sold a lot of stocks at that time. It was going down, and I sold a ton of stocks. Actually, yeah, that was like, what was that? That's 15, 16 years ago now. Yeah, I sold a ton of stocks. Now, we were fortunate. We owned our house outright. But yeah, I sold a ton of stocks. In fact, it got worse for me personally. I'll let you go into my personal affairs a little bit. I had written my second book called The Lazy Investor. That did phenomenally well. Now, I was still fairly early in my book reading career, and I didn't know that the books were going to go well. So at that time, my whole situation was structured as a sole proprietorship. So to even compound the problem, I was getting all sorts of money. Like Chapters Indigo would send me these huge 6-figure checks because they were selling, my books were flying off the shelves. And so I said, I have all this money. I'm going to take it and invest it because that's what I know how to do. And so I was doing this in early 2008, so buying stock in ABC at $50 a share. Well, late 2008, 2009 hits, my taxes are due, but the stock that I bought at 50 is now worth 25, and I have this huge tax bill owing. That was horrible. So we actually had to take a line of credit on the house to pay the tax bill. And I had some options as well, which I was doing, which I had to close out those positions at a loss. It was horrible. It was horrible. It was a horrible experience, which is why I'm way more conservative now in my investing. Why I used to do margin, I used to do options. I've kind of rolled back a little bit. I still use options sometimes to buy stocks, but generally not. Very, very conservative now. So does that answer your question?
Absolutely, but there's more. There's a silver lining when I think you did sell a portion of the portfolio to then buy U.S. stocks.
Yeah, so
And that may have been one of the best times to buy because of the currency conversion rate, right, between CAD and USD.
Yeah, looking back on it, okay, so things went well because at that time oil went up to like $140 a barrel or whatever, and everybody was talking about peak oil. And I had oil stocks, which was good. I was able to salvage some. I sold that. But yeah, because of that, the Canadian dollar, it's hard to believe where we sit, at 70 cents, 71 cents today? I haven't checked it, but we're around there. But at that time, the Canadian dollar was slightly above or slightly below, around.
That was a gift. When does that ever happen, right?
Roughly parity to US dollar. Now, the last time that had happened in my life was when I was in diapers in the early 70s, when there was a commodity bubble. So the market offered this glorious opportunity, and I stocked up on American stocks, and the next number of years were phenomenal. I mean, you look at the U.S. market returns over the last 15 years; they greatly outperformed the Canadian market. That was a gift. That was a gift. That was a beautiful gift, and the gift was compounded because in 2011 or 2012, I forget the exact year, the dollar was still pretty close. I think it was 95 cents or something. We sold our house. And we went traveling around North America for a year. We bought a trailer and we traveled around. So again, I had all this money. And I said, I'm going to buy more stocks. So I put all the house funds again into U.S. stocks. We traveled around for a year. Then we came back. We kind of had a gun to our heads. We had to get a house real quick. So we rented. And it was very comfortable renting. So we rented for 2-3 years. And in 2016, if you look, the dollar had gone down in the 70-cent range. We cashed out some of those American stocks and bought another house that was roughly comparable to what we had sold. So the full round trip kind of worked out. We sold the house. We invested the money, and then we cashed it out. We ended up with 2 or 3 houses, if you follow me, just the way the market worked, just the way exchange worked. And that was wonderful. So that kind of recouped what we had lost and more, quite a bit more. But anyways, yeah.
That's just great. And you touched on an option strategy, and you talk about it in your book.
Yes.
Selling puts. Can you talk about that selling put strategy?
Yeah. So basically, I don't do that all that often now. It's been overplayed in the media somewhat. They're like, "Oh, you're an options guy," and it's like that's like 1% of what I do. But yeah, if I see a stock that's cheap, what I might do is I might buy some shares. And then I might sell put options at a strike price lower. So let's say ABC company, I'm just using random companies. ABC company's trading at $100. I think it's a good value. I might buy some shares at $100, but I also might sell some options, let's say at 90, and get a small premium of 50 cents or $1 and see what happens. Because I get some money right up front. If it goes down more, it goes down to 90, I get to buy it at 90. If not, I've just pocketed the premium. So it's just playing both sides. But again, I don't do that a lot. I definitely don't do that with money I don't have now. I'm very conservative now.
Yeah, but I think the key point is that you're selling puts in companies that you gladly own.
That's all.
If it didn't hit the strike price, right?
Yeah, that's the problem with options. It can be alluring to look at crappy companies that are paying these massive premiums. You're like, oh, I'm going to sell that and make all this money, but it's only with companies I want to own already. Yes.
Exactly. So you've rebuilt your portfolio since.
Yes.
What does your portfolio look like today? If you're telling me about the top 10 holdings, like where are you adding money right now continually?
Yeah, so
which companies?
So reverse of what it was in 2008, 9, 10, 11 or whatever, the Canadian dollar is trading at 70 cents. So the vast majority of my portfolio is now Canadian. I sold out of my U.S. I held my U.S. holdings for a number of years. And again, these were not Google, Apple, like things that people made. These were Coke, Pepsi, Union Pacific, Visa. Visa's my big winner. I bought Visa when they did a spin out because the banks needed to raise money, and that was my tenfold winner or whatever. But no massive home runs. I tend to hit singles as opposed to home runs. Hopefully, don't lose too often. But yeah, right now my biggest holding is actually cash. Okay, I have, and when I say cash, short term interest bearing investments kind of thing. Actually, what I've done, it was kind of a unique opportunity right now because yields were so low a couple of years ago. I can buy Government of Canada bonds, which will yield like 1/4% or 0.5%, and I buy them at a discount to par, so that when they and I keep it less than 2 years, but when they mature in 2 years, what I'm saying is a lot of the imputed interest I'm earning is taxed in the form of a capital gain because I'm buying it at a discount. So that's where I keep my cash because tax-wise it's favorable, and I have a lot of cash right now. Outside of the rest of my portfolio is predominantly Canadian. The only foreign companies I own, and again, this is because I'm a mindless robot and I follow Warren Buffett. I bought some Occidental Petroleum, but that's a small holding. I have the British market is kind of crummy, so I always own tobacco stocks because they've done well for me. So I own some shares in British American Tobacco. I own some shares in Diageo, which is a big liquor company. It's a international company, and I own some shares in British Petroleum because it's been so poorly run and the price is cheap. Aside from those holdings there, those four, the rest of my portfolio is all Canadian.
That is interesting. When did you make that shift to a predominantly Canadian portfolio?
A bit too early. A couple of years ago, I sold out. A lot of the positions that I bought right after the 2008-2009 financial crisis, I held until about 2021. And I looked like a genius because I sold a lot of those, and the market in 2022 wasn't very good. But of course, I just held cash, and it's gone back up. So I haven't been that good. But yeah, I probably turned those back into Canadian dollars in around 2021, early 2022. I don't remember the exact date, but a couple of years ago. And since then, I'm very hesitant to buy any foreign companies because our dollar is so weak.
And so, what Canadian companies
Yeah, so
are you in?
I have some weird ones a little bit. I have a little bit of gold because I don't trust the government's responsibility with our government. So I have the problem is gold mining stocks are the crappiest investments around because you dig a hole in the ground and it costs a lot of money, and you're beholden to the price of gold. So I like gold royalty companies. I had some shares in Franco-Nevada, which is the granddaddy royalty company.
Mm-hmm.
I sold those and switched it over to Sandstorm, which is a smaller company. I really like the company. They have a lot of royalties. They've expanded recently. And what they're doing right now is the royalties are being built. They're coming on stream. And Sandstorm is taking the money and paying down the debt they used to grow. I really like the CEO, Nolan Watson. He's phenomenal. It's only $1 billion market cap company, but I think it has a lot of future growth. So I like it. So I own that. So that's my gold exposure, basically. I think Canadian oil is kind of on the cheaper side. I've bought some oil stocks lately. Again, the amount of free cash flow they have is phenomenal. Some of them pay dividends, generous dividends. Well, all of them pay some dividends, but some of them pay really generous dividends. But others are just taking their money and buying back shares, which I'm totally okay with. The Canadian oil industry is a little bit unique, or some pockets of it is a little bit unique because we have the oil sands. So the oil sands, it's billions of dollars to get the operations up and running. But once they're up and running, the oil's there and it becomes a mining operation, and it just becomes automatically cash flowing over time as long as oil prices stay high enough. The other thing too is because they're Canadian in nature, a lot of their expenses are in Canadian dollars, like they're paying their workers Canadian salaries and whatnot, but oil is reflected on the international market. I know there's a discount between Canadian oil and blah, 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 but nonetheless,
Mm-hmm.
they're getting international prices, if you follow what I mean. So even if
Mm-hmm.
oil is $70 a barrel US, I think it's 68 today or something, that's roughly $100 a barrel in Canadian terms, right? You're paying your workers in Canadian salaries, your taxes are in Canadian dollars, blah, 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 blah. It's a little bit of an opportunity I feel there. Prices are fairly cheap. I own some shares in Nutrien. Similar type of operation. They have 100 years of production. They grow potash. They pay like a 4.5% dividend. So I get my dividend. It's growing slowly, but they have tons of free cash flow because if you look at it, every year they buy back shares. So I understand that it's cyclical. I think it's on a lower point right now. They're not the lowest cost producer because Russia and Belarus are lower cost, but they're fairly low on the cost curve. Happy to own them. And then the stalwarts, right? Like TD Bank, because they were money laundering and stuff. And who doesn't like a bank that likes to launder money? No, I'm just joking. The price is cheap. So, you're getting a 5.5% dividend out of the gate. You don't expect it to grow that fast, but you don't need it to. You don't need it to. If it grows 4% a year, there's your 10%, right? Or whatever, right? So yeah, I bought some Rogers because the telcos have been beaten up. Rogers doesn't pay, like I'm a little worried about Bell because their dividend's a little bit too high, but Rogers has been more logical. They merged with Shaw a couple of years ago. They're bringing out costs there. They have a lot of debt. They're going to be paying it down. Am I getting boring, or you want me to keep going?
This is good. If we can just park on Bell.
Yeah.
Bell Canada's dividend yield is above 10%.
Yeah.
The street wasn't too happy with a recent acquisition in the U.S.
Yeah.
But 10% dividend yield, most people should be salivating, but you're not. So why?
Because it's going to get cut, or it might get cut, right? So I would rather buy it. I mean, go take a look at Algonquin Power. Okay, a couple of years ago, they cut their dividend. They cut it twice, I think, 40% each time. I think Bell is unsustainable. These companies, like Enbridge has been a great company, but why do they keep raising their dividend? Just be a little bit less generous and make it payable forever. So I'm worried. I could be wrong. Maybe this could be a golden opportunity to buy Bell. If they're able to muddle through and keep paying their dividend, you're going to look like a genius 5 years from now. But there's too much risk, and I said earlier, I'm not interested in taking on too much. I'm conservative now. So I think there's a chance of them cutting their dividend. But I want to give you another example that nobody thinks of, but I do because I'm in the country. Superior Plus is $1 billion market cap company. They distribute propane. Now that's outside of your radar because you live in Toronto, right? Like you don't even, the only propane you would buy is a little tank for your barbecue or something. But us rural guys, we have a big tank in our backyard, and there's certain companies that come and distribute propane, and that's how we heat our house, right? And so Superior Propane, if you look at it, I don't know the exact market cap. It's around $1 billion, but it's the biggest propane distributor in Canada. They cut their dividend 75% about a month ago or something like that. After they cut their dividend, I bought. Now the stock is up 12, 13% in a month. I'm going to hold it, okay? They're a price taker. They're not a price maker because they're selling propane. It's a commodity product. So, they're not able to charge their customers more. But by being the biggest, I think their cost structure can be lower because, if you're a small company, I'm just using an example. If you have to drive a mile between each customer you have the employee cost and the gas costs and stuff for the truck. Whereas if you're if you're a market leader and you only have to drive half a mile each time, your cost is lower. And so I think they benefit from that. Now, the other thing too is Superior Propane is the largest propane distributor in Canada, but they're also something like the third or fourth, I don't know exactly, largest propane distributor in the United States. Now, the interesting thing is companies 1, 2, and 3 are also are all master limited partnerships in the United States. That means the cash flows through them to the shareholders. They're not interested in growth. They're interested in paying dividends. Now, that is an incredibly fragmented industry, and I think there's some potential there. So I'm going way off on a tangent, but that would be an example that where
that's what I like about you, though, right, Derek? Like you're a contrarian. You think outside the box. Who right now is bullish on oil and gas, but we do have a potential situation, hopefully fingers crossed, where we boot out the current administration in Canada, and then we bring in a more oil and gas friendly prime minister and a more broadly business friendly prime minister for Canada, where Canadian companies can thrive again.
And pipelines. Energy East. I'm not saying Energy East. There's all sorts of Keystone, whatever. There's all sorts of pipelines. Well, now we have probably a favorable administration in the United States. I would argue it looks like it's going to be a favorable administration in Canada. Things will get built. I don't know exactly which ones, but there's too many resources there. I mean, and I know eventually oil will be, what I want to say, a legacy energy source. I get it, but we're not there yet. We're not there for the rest of my life. So I'm quite content to own it when everybody hates it. Yeah, I mean, to me, when I look at oil, it's like the tobacco industry. I mean, if you take a look at Jeremy Siegel's book, because he did the data, going back to 1925, the top performing stock since 1925 was Philip Morris. And why? Because everybody hated the stock. So it was always cheap. So you got a high dividend right out of the gate. They were buying back shares while the stock price was really, really cheap, and it's the best performing stock. Well, where are we at with oil right now? Everybody hates it. It's the end of the world. They're buying back a ton of shares. They're paying out okay dividends. I don't know. Maybe I'm wrong, but that's the way I view it.
And you're also a contrarian when it comes to your personal life and where you're living. Currently, right now, where you're at, you're on 85 acres, land that you recently bought. You bought a new house outside of Ottawa. So tell me about that change in your life.
This was my wife's thinking. I'm a city guy, or at least a suburban guy. I like to be able to go, walk and get a bag of milk sort of thing. So she was bothering me and stuff. So I guess, she wanted to move out to the country. I wanted to stay in the city. So I guess we compromised and ended up moving out to the country. But anyhow, yeah. So, I don't know. Like, I have 8 kids. It's kind of appealing. It's nice to, we have bonfires at night. We have a little bit of space. I got myself a Kubota tractor so I can feel cool and manly and stuff. And, down the road, I mean, again, I have 8 kids, and I have this pipe dream of severing off 8 lots because land prices and house prices are so high. I don't know if that's ever going to come to fruition. But yeah, my wife and I, after we moved in here, like at our old house, to get to Costco, we use Costco as the anchor there. It was about a 12-minute drive because there's a few traffic lights on the way. Well, now we're probably driving triple the distance, but my wife can get there in 15. She drives faster than me. For me, it's probably 18 to the nearest Costco. So we're in the country, but we're very close to civilization. So we're getting to go. We'll see how it goes. Yeah. And land holds its value in inflationary environment too. Like it is an asset to a point, you know.
So besides, the Costco trip weekly, what do you do during the day? Like what fills your day?
I spend too much time looking at the stock market because I find it very fascinating and interesting. Like I'm such a boring guy. I would rather sit and read annual reports than watch a movie or something. So I enjoy doing that. So it's kind of fortunate I'm doing that. And then I'm learning how to do all the farming stuff. As I say, I got a tractor. I paid way too much because they're expensive, but I'm looking forward to the first big snowfall so I can go out there and plow it and stuff. And other than that, yeah, just basic things. Play badminton on Monday nights sometimes, hang out with my wife, get my kids launched and all that kind of stuff. And yeah, I don't know, whatever. Whatever. I'm a boring guy. My wife and I are going to Cuba next week, so just for a week. So yeah, but other than that.
Obviously, you're very good at controlling costs, right? You have the dividend income coming in, but are there any areas where frivolous spending is just let's just do it, let's just spend money on it?
Yeah, I mean, again, like okay, so it's a bit of a different dynamic because I have 8 kids. So for example, pre-COVID, whenever it was anybody's birthday, and again, there's 8 of them or 10 of them in our family unit, we would go to Montana's, like a restaurant, and we would go on the Tuesday night, the week that it corresponds to their birthday, because kids ate free on Tuesday. So we would buy, 5 adult meals for me, my wife, and the older kids, and then we get 5 kids meals for free, and everybody was happy, and it was affordable. Well, now eating out has doubled in price or whatever, so now we've switched gears a little bit, and I just take the one kid out. We go to the Mandarin buffet, and I treat them. It's one-on-one time, or if my wife comes, it's 2-on-1 time, and that's the way we do it now. So we've kind of changed. Frugality and stuff was so huge when I started out because I didn't have that many dollars. So if you want to accumulate wealth and you don't have some great business idea or something, like you're not a Jeff Bezos or whatever, you're just an average guy, idiot like me or whatever, the way to accumulate wealth is obviously to spend less than you earn. The less you can spend compared to what you earn, the faster you will accumulate that wealth. So in the early years, frugality is incredibly important. Once you get to a certain stage, how you manage your portfolio becomes much more important than how much you're spending, if that makes sense. I mean, as long as you're not off the rails type thing,
And the reason why I ask is because you're not that extreme where you're saying, cut out the $2 coffee from Tim Hortons every day.
Yeah, it's
right?
probably
Like you're still living your life.
It's probably a bad example because I don't drink coffee. But yeah, I mean, I don't know. We bought a car. Like, okay, so we have a minivan, of course, right? We have a Honda Odyssey, and then we needed a second car, and then my daughters, like, they're driving and stuff, and I'm thinking, so we bought a Corolla. Like, that's not fancy, but it's practical. It'll last long. It'll be reliable. It's fairly good on gas. It's middle-class lifestyle without working, I guess. I don't know. Like, my wife and I are going to Cuba. I mean, we did take a year off and travel around the trailer, but we don't do a lot of really fancy things. I don't know. It's whatever. I mean, yeah, I don't know. That's about it. But I don't have any real habits. Like I'm not a smoker. I'm not a drinker really. Like I'll have a beer now and again. But and yeah, like we don't eat out a lot. My wife's from Korea and she doesn't like eating out that much. So she sort of changed it from okay, so we'll eat at home. That's fine. Whatever. I don't know. Simple life. Yeah.
And what's your take on the whole FIRE movement, financial independence, retire early? Like you like invented FIRE before it was ever coined that. What's your thoughts on it now?
I mean, life is short, and I guess like working does interfere with your free time. So if you can avoid working, you'll have more free time and probably a happier life. So that's reasonable. I think it's fine. Everybody has to do what makes them happy as long as they're not hurting anybody else. In the FIRE movement, some of it seems a little extreme to me, though, sometimes. Like, and maybe I don't know, was I extreme? I mean, I was very frugal, but I did backpack in Europe and Australia and went to Vancouver and Asia and all that kind of. I don't know, like it can seem extreme. I don't know what else to say about that. I mean, I think it's good, but like let's say you have this FIRE goal, but then you don't do anything else in your life. Like you're like, okay, I'm not gonna go on a vacation because I have this FIRE dream. I'm not gonna buy a car. I'm going to just take public transportation because of this. I'm not going to have kids because they're expensive. And, I mean, it depends on what you like for yourself. But you got to be careful that you don't do it to the exclusion of everything else, I guess. It depends on the individual, though.
That's why I ask. And so, out of your 8 kids, which kids have taken to stocks in the stock market? Like, are they reading the annual reports with you?
My older kids don't seem to care that much. I have an 11-year-old that likes to read. We're reading The Wealthy Barber, which is a really old book right now, but we're going through that. And then I have a 14-year-old son that read my books like 4 years ago. I mean, he read all of them, which I was really surprised. I don't know if anybody's read all of them. I haven't even read all of them. But yeah. So
I've read all of them.
Yeah, oh, there we go. So he read those and stuff, and I don't know. That was kind of interesting. But he's more interested in politics now. So I don't know. Yeah, I mean, I don't know. It's interesting because I mean, if you go to somebody that's many multiples of me, like 1,000-fold multiple of me as far as investing knowledge goes, Warren Buffett. I mean, his kids didn't follow in that path, right? So it's kind of interesting. Here you have the greatest investor of the century and perhaps of all time, and yet I think one of his sons is a farmer, one guy was a musician. I don't know what his daughter does, but it didn't seem like they were all that interested. So it's kind of interesting. I don't know.
And when your kids are asked at school, so what does your dad do? What do you think your kids say?
My daughter says, my dad's unemployed. Yeah, that's kind of funny. I don't know. I don't know. I don't know if it comes up that much. It's a really good question. My dad wrote some books, blah, 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 whatever. I don't know. I don't know if they really even talk about it all that much, quite honestly.
What books inspired you early on? What was that one book? The Millionaire Next Door, for example.
Yeah. When I read The Millionaire Next Door, that was me. Like, I look at it, like, not 100%, but yeah, okay, that makes sense. And actually, when I was reading The Millionaire Next Door, my ancestry is Scottish. And if you read through The Millionaire Next Door, there's a chapter called The Thrifty Scots. And what he does, he says, look at the data. The Scots don't make any more, they don't make more money than the average American. They don't. It's right down in the middle. But look at their saving rate. And I'm like, that's me. 100% that's me. And I've sort of had puffed out my chest. Hey, I'm Scottish. Maybe I'll go buy a kilt or something. I don't know. But yeah, so that was a big one. That set me on track. With investing, The Wealthy Barber came out at a time when it sort of turned the light on my head. Like, oh, if I save regularly, I can be retire early. It was a different path than most people that want to get promotions and blah, blah, blah. That was good. And then for investing itself, Peter Lynch's One Up on Wall Street was really, really good. It sort of empowered me like, oh, I can do this on my own and stuff. And then, of course, again, we're going back to the 90s. Like, we're going pre-internet time. But I stumbled upon Warren Buffett, and I started reading about him. And that made a lot of sense as well. So it's a combination of factors. But I was seeking it out, right? So, you find it. But information is so readily available now that it's so easy to find. But then you don't know the quality of the information because anybody, some guy could be unemployed in their underwear in their basement posting something on a website. Who knows, So anyways, yeah.
Since we last talked 10 years ago, Bitcoin is all over the news, right?
Yeah.
It's all about how to get rich buying Bitcoin.
Yeah.
What's your opinion?
I don't understand it. I don't touch it. I'm really boring. Like, I'm really going to bore you because I guess for a short time I owned Apple for a very short time. But I mean, back in 2000, 2001, there was the .com bubble explosion. The markets went down like crazy. And Amazon lost something like 92%. And I remember having a discussion with this guy, and he's like, I think I'm going to buy some shares in Amazon. And stupid me, I'm like, what are you talking about? All Amazon, again, we're going back in time, so in fairness to me. But all Amazon did at the time was sell books to people at a loss. I'm like, what is this business model? I cannot understand that. So I never bought that. I miss out on all of these things. But it's kind of interesting. If you want to have some fun, any of your viewers, Google the company Stella Jones. Stella Jones makes railway ties and telephone poles. Okay, this is old school. This is 200-year-old technology. And the stock performance over the last 20 years has beaten, I think, don't quote me on it, but I think all of the FANG stocks. Okay, so yeah, I mean, would I be wealthier if I knew about nanotech and biotech and the Mag 7 and all that? Possibly, I don't know. But there's usually not big blow-ups for me, and I've done okay, and I'm pretty content with that. But yeah, I don't know.
You retired 20 years ago. A lot has changed. We've had rampant inflation.
Yes.
People today who are growing up are thinking, how the hell do I even buy my first condo?
Yes.
Let alone a house.
Yes.
If you were to do it all over again, Derek, if you're a young person in your early 20s now, what would be your roadmap? Would you do it differently?
Well, I'd have to do it differently because the world has changed, right? If I was doing it now, I mean, it would still be frugality. It would still be spending less than you earn type thing. Right now, it would be maxing out my TFSA. If I was really young, first would be maxing out my first-time homebuyer savings account because I'd also get a tax deduction. I would be maxing out my TFSA. Um, I know technology has advanced, but if I was born today or if I was younger, maybe I'd be more in tune with that. So maybe those would be options to invest in that. But with my little brain that I have right now, I wouldn't be focusing on that. I'd be focusing on the same kinds of companies, the CN Rail. CN Rail. I mean, the technology hasn't changed in 120 years or whatever. What a phenomenal business. In fact, the price is kind of on the cheaper side right now. I bought some recently. I might buy more. But it's a phenomenal business. It has a competitive advantage, way cheaper than trucks. And the beauty of it is it's a capital intensive business. So if they increase their prices, which they can because they're cheaper than trucking, by like 2%, it falls to the bottom line and increases their earnings by like 10%. So it's not like something like NVIDIA that's going to quintuple in 6 months or whatever. But it's a good, solid company, Anyways, yeah, I'm getting off on a tangent.
That's just great. Tax strategies. Are there any more tax strategies that you can mention, or money hacks? There's the best kept secrets.
There's the boring best kept. The boring ones, of course, maxing out your TFSA, maxing out your first-time homebuyer savings account, buying a house because houses are exempt under the principal residence exemption, blah blah blah. So that's all very boring stuff. If you want interest earning income, I mentioned it earlier. You buy the bonds with the low yields, and then you're taxed in the form of capital gains instead of interest, even though it is essentially interest. It's guaranteed, but it's just the way the tax system works. Don't do that with zero coupon bonds because you have imputed interest. So don't do it just with a low yield, 0.25, 0.5. Other than that, I shifted part way because when I was starting out, I was content to own something like, and not today, but a BCE going back like with a 5% yield, or that was reasonable and maybe grew at 2 or 3% a year. I sort of switched because it was I was having to pay tax every year, so I was quite content to own something like, and I'll use the CN Rail example, that's growing earnings at 6, 7, 8% a year, only paying a 2% yield. So I'm only paying tax on the 2%. And the 6% is growing on compounding tax. I mean, Buffett talks about that. I owned Berkshire Hathaway shares for a long, long time. I wish I would have held them. I didn't. But anyways, live and learn. But yeah, did really well. And he talks about that. And he can grow it within that corporate structure. And you're not paying any tax for year after year after year after year. So I think this is not, fancy secret hack. But, rather than having a 6% yielder with a 3% growth, why not a 2% yielder with an 8% growth or something like that? That's safe.
So more of a dividend growth company.
Yes, for me now, because my assets are high enough that I don't spend all the money I'm earning. So why do I want to generate a lot of income, pay tax on it?
Books. Are there any more books that you're planning to write and publish in the future?
Not right now. I haven't written a book in 10 years, I think, or something. And I don't know. I did it. I wrote it. It was fun. I enjoyed it. Don't get me wrong. But no, I don't know. Do something else. I don't know. I just don't feel like it right now. I don't know. I don't know. No, not really on my radar. And the book industry has changed too. Like when I first came out, there was only a few channels where you were getting, you know what I mean? Like you'd contact a newspaper like the Globe and Mail or the networks or something. Well, nobody watches TV anymore. Nobody reads a newspaper. There's thousands of different podcasts or whatever that people listen to. And so you have to really work hard at it. And I'm kind of lazy, so I don't feel like doing it. That's the honest truth.
It's completely changed, right?
Yeah.
And even from 2016, when my book Market Masters was released, it's completely changed. Who's going to read a 600-page book anymore?
Yeah, 100%. People don't have attention span. You need a series of YouTube shorts or something. Yeah.
Yeah. I remember after interviewing you for the book, you gave me the tip. You said, hey, to promote your book, you've got to go to the library. You got to take out a book called, I think it was 1001 Ways to Promote or Market Your Book. And that was awesome, Derek. I thank you for that. It worked. It actually worked.
Yes.
I went through the book, and there's so many good strategies.
Yes.
If anyone's out there who wants to know how to market their own book. You also launched a YouTube channel. I see now that it is dormant, but you do have tips and strategies on there as well on your channel.
Yeah, I don't really have a YouTube channel. No, what it was when we were traveling in the trailer, and we were swimming with the kids and whatever, and we ended up in north of Houston, Texas for a couple of months, and I was kind of bored. I'm like, I haven't done anything in a while. And I thought, oh, what can I do? And I guess out of the library, I checked out a book. I forget it was called Laptop Millionaire. And I looked, I said, oh, I'm going to do this. I'll make an e-letter. It was kind of cool, actually. I made an e-letter, sent it out to my mail list, and I got enough orders. I think I made like $50,000 in 3 days or something. It was good. It was good.
Beautiful.
So it was like, nice. And so I did that for a while and stuff. But no, I'm not really, like, again, like I chatted with a fellow that's an expert in this, and he said, you should do this, you should do this. And he was kind of right. And I kind of opened a Facebook account. And I started, and I said, this feels like work. Like, I don't really want to do it. Sorry, I'm really lazy. So I said, I don't feel like doing this. So I backtracked out of there. I know, I'm not saying I know how to do it. I don't know all the algorithms and da-da-da. I know how the system works. I'm just not interested in doing it, if you know what I mean. Like my son's talking about making YouTube videos, and kudos to him. Good. But it seems like you have to develop content every week. You're under the gun, or else, you know what I mean? I'm just not, at this stage, I'm not interested. I'm sorry. I'm just not interested in that. Yeah.
So when you first came out and you retired at the age of 34, I think you had TV channels reach out to you.
Yeah.
What was the most memorable TV interview back
Well, at the
then?
time, I had an interview with George Stroumboulopoulos at the Hour.
Yes, tell us about that.
That was out of the blue, actually, because they contacted me. And I remember talking to my
Oh,
friend.
really?
Yeah, it was really weird. And
How do they happen upon you?
I don't know. I don't remember. I mean, the old system, which doesn't exist anymore, is you get in with a newspaper, preferably the Globe and Mail, and then a lot of these places, like at the time, this is not true anymore. They would read through the Globe and Mail, and they would, oh, this would be interesting, and they'd reach out. Somebody in their department would reach out. But anyways, they reached out to me, and I remember talking to my buddy. I'm like, yeah, I'm going on the show, The Hour, or whatever. He's like, really? Like, they want you? And I'm like, yeah, they just called me or whatever. So it was kind of neat. We went in, and George was a great guy. And I remember they had like a little bar in the green room before you could go. I didn't have anything, but yeah, they did. That was the only time. Yeah, I was on breakfast television a few times. Blah blah. But again, the world's changed now. It's all different. Really. I mean, YouTubers like my son follows a Mr. Beast or whatever, and like it's just
Mr. Beast.
the world
He's
is
blowing up every video.
the world has changed. That's all I can say. And as you can see from this morning, when it took me an hour to figure out this podcast, it's passed me by. I'm still horse and buggy over here, but we're fine.
After that George interview, did you get emails from fans and people interested in reading the book? Like, what was the result of that interview?
We got book sales. The thing is I didn't maximally monetize my brand, if you will, and that's fine. We were busy with our family and kids and stuff. But I mean, obviously, the next step would have been a monthly subscription service of some sort, and I never really did that. I did one-off subscription, and I mean, you buy a book, that's great. People buy it, they read it, and then if they like it, maybe they'll buy another book. But you have to keep coming up with a book, right? Monthly subscription would have been the model, but then I was just busy with the kids, and we were just at a busy stage in our life and whatever. So I'm like, maybe I'll step back. This has been fun. I'll go do something. I don't know, just go buy a farm or something. I don't know, So yeah.
Just live your life, right? And yeah, like it's totally changed. The whole mainstream media
100%.
platform is just evolving rapidly.
Yeah.
Anything that we left off the table? Is there anything that you want to mention? If people want to go buy your book, for example, where do they go?
Yeah, sure. If you want to get my book, you can go to stopworking.ca. If you have a question, I can try to answer it. I don't get into specifics. I'm not a licensed financial advisor. I'm not going to say, hey, you should buy ABC stock company today or whatever, that kind of thing. So stopworking.ca. You can take a look at the books. They're still applicable. I mean, my last book was written in 2012, I think. But the data, I mean, if you look at The Idiot Millionaire, which was published, I don't know, 2010, I'm guessing, I don't remember. All of those stocks, or not all of them, but the vast majority of them are still very applicable today. Like I think I listed Tim Hortons. I mean, people are still going to getting coffee, Coca-Cola. People are still drinking it, or their derivative products, Pepsi Cola, CN Rail, whatever. They're all in there. It's all the same boring stuff. The one thing I'd add for people, I mean, some people are smarter than me, kudos to you, but careful of risk, right? Careful of risk, because high tech can change in a nanosecond, it can change very, very quickly. Be careful of that. I found the best stocks are, get better with age. If you buy something that's been in business at least 50 years, maybe 100 years, something that you use regularly, something that just has an incredibly long track record, it's not as sexy or as exciting as NVIDIA or whatever. But there's also not the big blow-ups either, and that's what I found. Like, I mean, I know that you did capital compounders and, you rooted out a lot of companies, but I'm sure some of those probably fizzled. I don't know. I don't know. I haven't looked at your list, but I'm sure there's some real stuff.
There's a lot of risk involved in investing in smaller startup companies like micro caps and small caps,
Yeah.
and even mid caps. companies that have achieved $1 billion market cap, the future still isn't certain because they may have been in business for only, let's say, 10 years.
Yeah, exactly. Right.
That's true.
That's also where you hit the one that you invest in $1 billion and 3 years later it's worth $100 billion or something. So that's where you can have a big win, but big loss. So I would say people be careful, or at least be careful with the majority of what you have, because it's really be disconcerting or discouraging if you invested in the wrong company right out of the gate and then you're just turned off of investing forever.
Yeah.
Yeah, and the other thing I'd add too is I've made so many stupid mistakes. Like that would actually be a good investment book if I wrote a book all the mistakes I made. And yet, in spite of that, because the stock market is the best wealth generating machine that's ever been invented, in spite of that, I'm doing okay. Okay, I've made mistakes. I mean, I remember, I'm going to go off on a tangent again, but 1996,
Let's hear it.
After coming back from Australia, I was sick of being in Ottawa. I moved to Vancouver. And I'm walking around, and there's this company, and I didn't even know what it was. It was called Starbucks. Maybe you've heard of it. I don't know. But they had them on every street corner. I'm like, what the heck is Starbucks? I asked my friend. He's like, oh, it's a coffee shop. I'm like, coffee? Coffee's a much better business than a hamburger place, because a hamburger place you go once or twice a week, but coffee is a daily ritual for people, or twice a day or whatever. You know what I mean? Like it's what a phenomenal business. And I remember, and this is going to date myself, but I looked through the yellow pages, and I forget what the number was now, but there was like 54 or 37 McDonald's in Vancouver, and there was like 28 Starbucks. And then I started researching it, and I realized that it started in Seattle. It was only on the West Coast, so I bought Starbucks shares. And had I held on to them, they would have gone up like 20,000% or whatever in the last 20 years. But of course, a few months later, I sold them to buy my beloved Philip Morris. I said, it went up like 20% in 2 weeks or a month or whatever. I said,
so it worked out. It worked out anyway.
It worked out, but geez, it would have worked out a lot better. So the point is, you're going to make mistakes. Just don't make them be catastrophic. Don't get, and the other thing I'd add too, sorry, now that you think of it, is I tend to put limits. I don't want to invest more than, let's say 5%, maybe 6% in any one stock. Like I would never do the Philip Morris bet again today, because I don't have the courage to do that. I mean, it worked out well, great, but you might have chosen the correct lottery ticket and won money too, but I don't buy lottery tickets. So you know what I mean? So yeah.
Yeah. At this point, it's about capital preservation, right? Like you're not going to be taking those bold bets if you have 8 kids, you have a family.
Yeah.
To support. Are there any other mistakes that you learned from? I think this is probably the topic of your next book, and we sparked we sparked that in you, Derek. But tell us.
Yeah, no, I mean, those are the big mistakes. I mean, I think being overconfident at times. I've been overconfident. It's funny, I think I know 100 times. Well, maybe not 100, but I know a lot more about investing now than when I first retired at 34. My knowledge has grown, but yet my confidence level at 34 was much higher than it is now, which is kind of interesting, right? So yeah, I don't want to have a big blow up, so I'm always looking at the downside. Like for example, you brought up Bell. I looked at Bell and I'm like, ooh, if Bell cuts their dividend by 50%, I might buy some Bell, but I'm not willing to take that risk right now. Yeah. So Bitcoin, I don't really know.
Exactly, it's too much of a risk.
Yeah, I don't know what Bitcoin, like, I know it's been great. A lot of people have made money, and congratulations to them. I don't suffer from FOMO. I'm okay. If my net worth is X now and it becomes 2X, I don't think my lifestyle changes all that much. So the risk of losing what I have is a much bigger factor in my lifestyle than gaining more at this stage. So I got to keep up with inflation, that kind of thing. But I don't want to take too many risks at this stage, kind of thing.
Absolutely. Well, this has been a lot of fun, Derek. Thanks again for sitting down and having the conversation.
Okay. Well, thank you very much. And sorry it took me so long to get online, but there we go. We were able to do it eventually.
It's all good.
That's why it's the Idiot Millionaire. See?